Moving averages. Moving averages are another tool used by a variety of traders across the industry. In fact, I would say it's probably one of the most used indicators traders use. There are several variations, several numbers, several time periods that we use different moving averages on. So for those of you that have previous experience, you may be used to using moving averages that are not set to the same standard that we use. Moving averages give us a basic idea of how trend is performing. Of course, we have to add other factors in. We use simple moving averages, SMAs. SMAs are used to determine trend direction. If an SMA is moving up, the trend is up. If an SMA is moving down, typically the trend is down. We can use moving averages to act as dynamic support, so floor or resistance, ceiling. We can also use moving averages in terms of our entries. What we need to remember is that there are millions and millions of strategies and indicators out there. The bottom line is that they all come back to the same chart, same day, same time. So the key thing that we need to have a great understanding of as traders is price action. So reading the candlesticks, understanding which each bar represents. But we can use indicators like moving averages to make life a little bit easier for us, to help spot what direction the trend is heading in, or to use a moving average as a level of support or resistance for your entries, therefore giving a more disciplined approach, i.e. wait for price to bounce off a moving average before entering. They can signal a switch in market direction when SMAs shift from support to resistance and vice versa. I personally like to look out for a moving average crossover. The key crossover for me is the 20 and the 50. This confirms a change of direction. Ignore moving averages in ranging or noisy markets. So in an ideal world, when price is above all moving averages, we buy. When price is below all three, we sell. When price is trapped in between moving average, the market is going sideways, it's noisy, we stay away from it. As I said earlier, if you're analyzing a chart for longer than 30 seconds or a minute and cannot work out which direction the market is heading in, simply move on. There are tons of asset classes, a variety of currency pairs that you can trade from. The key here, as always mentioned, we are here to cherry pick the high probability setups. A moving average is an indicator, not a strategy. So as I mentioned, there are a basket of other things that we need to see in order to take a position alongside a moving average. We don't just trade because the moving averages are showing us something. Now we use the 20, the 50 and the 200 to determine the trend of the market. Now the 20 and 50, as I mentioned, I'm sure some of you would have picked up, is my favorite cross. So when a 20 crosses a 50 moving average to the upside, I will look for opportunities to buy. When a 20 crosses a 50 to the downside, I will look for opportunities to sell. Now, what is a moving average? Well, the 20 moving average, now the industry standard color for 20 is blue, is the average close over the last 20 bars. So if this is a daily time frame, this is the average price over the last 20 days. If it's a 1 hour time frame, it's the average price over the last 20 hours. Now the industry standard color for a 50 moving average is red. So again, if this was a daily chart, the 50 red moving average would show you the average price over the last 50 days. And of course, the last being the 200. Now, the 200 being the slowest moving average, of course, is giving us an average over a wider period. This could be on a daily chart, the average price of the last 200 days. So it's heavily respected. Now, if the average price over the last 200 days is heading up, we will look to buy. If the average price of the last 200 days is heading down, we will look to sell. So this is exactly what we're looking for here. And I just want to go back to some of our earlier slides where we're looking at our push and pull phases. Push, pull, push. So we now know this is an uptrend. And in an uptrend, of course, we look to buy. So our high probability setups are in here and in here, which is the end of the pull phase, start of the push phase. So end of phase 2, start of phase 1. So if we know we need to look for high probability setups in this area here, we can now see that when the market is trending to the upside, not only will we have our trend line through the middle or through the bottom, of course, acting as trend line support, we also have our moving averages in the correct stacking order. So the blue 20 moving average, being the fastest moving average, will be closest to price. So when we're looking for our entries, we will be looking for price to bounce off the blue 20 moving average. Bounce off the blue 20 moving average. So there is another indication of how we can identify the start of the move. Because as we now know from previous slides, we will not be entering at the end of a phase, of course, as there's less chance of profiting. We are now looking for the start of the phase. We are now looking at the beginning of the trend in order to enter. So when we're buying, we must see price above all 3 moving averages. When we are buying, we must see price above all 3 moving averages. When we are selling, we must see price below all 3 moving averages. So we have phase 1, the push phase, phase 2, the pull phase. Phase 1, the push phase, phase 2, the pull phase, phase 1, the push phase to the downside. So we are looking for selling opportunities every time price comes back and bounces off the 20 blue moving average. So our lower high formations are in here, our lower low, lower high, and of course down into a lower low. So we are using the 20 moving average in a downtrend as a level of resistance for price to come down, back up, give me a higher price to sell at, down I go. The pull phase, give me a higher price to sell at, reject the 20 moving average, and down I go. So another practice session here. Would we be taking the market long or will we be taking the market short? Now remember, long is when we're buying and short is when we're selling. Of course, price is above the moving averages, so we look to buy. Just to give you another example, this is an uptrend. So we have the push phase, the pull phase, come back to our moving averages, bounce, create a higher high formation. The pull phase back to the moving average, bounce, and there we go. So our higher low formation, the high probability areas, are in here and here. Okay, practice number 2, long or short, buy or sell. Of course, we won't spend too much time there. It is a short. We are looking to sell. The reason we are looking to sell is because price is below all 3 moving averages. So we have our push phase, our pull phase, and we sell. Our push phase, our pull phase, and we sell. Long or short, team, what are we looking for? Messy market, we do not trade. As I mentioned previously, if it takes longer than 30 seconds to work out the direction of a chart, step away, you have tons of other opportunities out there. So to recap, we use the 20, the 50, and the 200 moving average. When price is above all 3 moving averages, we buy. When price is below all 3 moving averages, we sell. When the 20 crosses the 50 to the upside, this indicates a change of direction and we look to buy. When the 20 crosses the 50 to the downside, this indicates a change of direction and we sell. Okay, if we now take a look at some charts, this is a chart of euro against the Swiss franc on a daily time frame. First thing that we can identify here is a 20 and a 50 cross. So the blue being the 20 has crossed the red being the 50 to the downside. This now tells me that sellers are entering and controlling the market. We will now potentially see a downtrend. Price has moved once to the downside and created a lower low. This is the push phase. The pull phase comes back and interacts with our 20 moving average. So we are now looking for selling opportunities in this area. We can also identify that all three moving averages are in the correct stacking order. So when price is below all three, we sell. And of course, the blue being the 20 is going to be closest to price, the 50 next, and the 200 further on. So we can see we have solid confirmation the market is trending to the downside. And of course, look what happens. Price rejects our blue 20 moving average, and we have the opportunity to sell. Price now makes a lower low. The pull push phase, and then we get the pull phase back into the 20 blue moving average. And again, we have another opportunity to sell. So these are our lower lows, lower highs, lower lows, lower highs forming. Price then moves, takes a couple of days to the downside, and we are in a fair bit of profit. If you're looking at an opportunity from the 20 moving average, it's 140 pips in front in 16 trading days. So just over 3 weeks there. Here is a chart of euro dollar on a daily time frame, and we can see the first thing we identify is the 20 crossing the 50 moving average to the upside, indicating a clear uptrend. We need price to be above all three moving averages when we're buying, so we get the push phase, the pull phase, and price gets back and interacts with our 20 moving average, giving us a reason to look for buyers entering the market and take the market higher. We get a higher high, higher low, higher high, higher low, higher high, higher low. So of course, when price is above all three moving averages, we're just waiting to buy the dip. We wait for the push phase, the pull phase, and then we look to buy with confidence because we've identified a clear trending market.